But so far, through the course of the day, we focused on debt markets. This is a Friday evening. We just had that beautiful tribute, Utpal bhai. So really great to see that. This is the last panel, and it's also the equity panel, and we'll try and make it as enriching, as value additive as possible. We've got some investing rates, really need no introduction. They've been introduced already. I don't think there was any need for that, because I think all these men are well understood. They've been practicing investing for decades now. The topic which has been given to us today for this particular session is value creation, value migration, and value protection. And we'll do exactly that. We will take this topic, divide it into three parts, and try and understand from all of our panelists how they've gone about doing all three, how they've created value over the years, over the decades of investing, how they've practiced this powerful theme of value migration, where they see opportunities off of this theme now, and of course, how they've managed to protect value, both while buying things and of course, selling at the right price as well. But we're also, as Utpal said, sort of talking in the shadows of some great people who are not amidst us now. Just earlier this week, we had one of the investing greats of all time, Charlie Munger, who left us. Really, one of the top minds, not just in investing, but also someone who taught us a lot about how to live, moral clarity, etc., etc. So, and by the way, I almost feel like I know Charlie Munger because I've read so much about him. But I know that a lot of my panelists actually have met him. They've been in Omaha, attending these meetings, and have had the opportunity to interact with him as well. So I want to just start with that in terms of what Mr. Munger, who's no longer with us, meant to all of our panelists. Mr. Damani, why don't I start with you?
Thank you, Prashant. Thank you, Nipa, for having us. Very kind of you. What a lovely audience you have here. Munger, of course, was, as Prashant said, the complete man. I mean, I think he lived 100 years, and I think his legacy will continue on for a few hundred more after that, because he kind of, anytime I didn't understand a question of, say, global warming or cryptocurrency or China, I would go and see Munger's view, and typically it was the best curated view that I could find. I'd just like to share the biggest partnership that we've known in corporate world was between Buffett and Munger. I think Raamdeo knows a few things about partnerships. But other than that, there are few partnerships that are as valuable as Buffett and Munger. And I'll share with you one instance where they agreed and one instance where they disagreed. And before Munger came on the scene, Buffett would want to buy stocks, what he calls cigar butts. Stocks that were so cheap that he could get free puffs and make a profit out of them. And then Munger, through the purchase of See's Candy, pushed him. Said, you pay $25 million, $30 million, which is about 3 times book at that time. But over the next 50 years, See's Candies produced almost $2 billion in profits, which was then reinvested in insurance business. So Munger kind of pushed Buffett to invest in great businesses at fair prices, rather than just good businesses at ridiculously cheap prices. So that was Munger's huge contribution to the field of investment, and they moved away from the classic Graham Dodd net, as they called it. The other thing is perhaps not as widely known, is in the 80s when Berkshire had already become a very large corporation, Buffett was a bit tired of traveling, so he bought a personal jet for Berkshire Hathaway. And Munger called that decision indefensible. So Buffett, rather than name the jet, Buffett 1 or Berkshire 1, named the jet itself indefensible. So that was one of the few times that they both disagreed with each other. But it was one of the more enduring partnerships. And as I said in a TV quote sometime, that a great teacher always affects eternity, because you never know where his influence stops. And I don't think we know how deep and how wide and how long Munger's influence will be on the investment thought process.
That's beautifully put, sir. Thank you very much for that. Raamdeo, you've been in Omaha, and I think you carry a small souvenir in your wallet, if I'm not mistaken, yes, which reminds you every day of both Mr. Buffett and, of course, Mr. Munger as well. Tell us about it.
Good evening, friends. It was crazy that I've been going there for the last 25, 30 years, maybe 30 years, of course, to Omaha. And when I started going in 95, 96, things were not that big. About 3,000-4,000 people used to come. And it was much easier to approach Buffett and Munger himself. In fact, if Buffett was approachable, Munger was actually standing amongst all of us to enter the hall. That was a condition. And then after that, you know, that 4,000 became 40,000 and they became super VIPs and things like that. But at that point of time, I had an opportunity to actually walk in. They had a special session for visitors where you could take signature from them. So I'm carrying a dollar bill where I took signature of Buffett as well as Munger in the same room. Way back, I think it must be 96, 97. After that, they stopped giving that opportunity to because the crowd became so big. So there is a fond memory of that. And the partnership is unbelievable. I mean, I think in many things they must have disagreed, but finally they agreed to disagree. But I think the most important thing for me was the compounding machine they created. And they said in 1963, Buffett said that we would like to make 10% over S&P. And that's what they delivered. In last 65 years, Berkshire Hathaway has done 20% compounded on a 10% S&P performance. When you have this kind of, the rate differential might not sound that much high, but when you do it for 65 years, you can do your numbers, you'll go crazy. So the biggest learning is you have to find your compounding machine, whatever way you want to compound, and then get on to really achieving it. One of the quote which I remember distinctly, to achieve extraordinary results, you don't have to do extraordinary things. So, there are a lot of quotes. There is no end to what he used to say, one-liners and all. But he was outstanding brain, a rational man in an irrational world of investing.
Again, very well put. Utpal, why don't you share some anecdotes with us? I mean, the most powerful idea which really gripped you and which kind of has stayed with you throughout your career in investing.
So, I've never had the privilege of meeting either of them or visiting Omaha. But Charlie Munger's book, Poor Charlie's Almanac, has been deeply insightful for me. And one of the key ideas that I took from there was that when you are able to find the right company, the right business model, and the right management team, then the flywheel effect of that over the years accelerates the compounding. And with that compounding, it becomes parabolic at beyond a point of time. So both those factors are important. The compounding is important, but compounding becomes more powerful with time. So people usually focus only on compounding. I learned to appreciate the role of time better when I first read Poor Charlie's Almanac.
You know, I spent, I think it used to cost about 7,000 or 8,000 rupees when I bought that book, and I said, well, that's one expensive book. It's been a heck of an investment, and I urge everyone to get a copy for themselves as they wish to. Mihir, you're someone who's managed money in an institutional setting for a long period of time. I mean, how's the thought process, the thinking of Mr. Munger, Mr. Buffett kind of helped you? What's the most powerful idea?
I think for me, of course, I have not visited Omaha, but for me, the biggest message that Munger has given is that if you don't understand it, don't do it. And they avoided so many businesses, and they were happy to let opportunities go because they didn't understand it. It was too complicated. And the second thing is that I think it's a dream to have a sparring partner like Munger. And I wonder whether Warren Buffett would have been as successful without Munger. So, you know, to have a partner who will show you the mirror and bring you to the truth is something that I think Warren Buffett is lucky to have.
I think...
yeah, I just add something because you asked about how the Munger helped our intellectual process in terms of thinking. There's a lovely article that I wish all of you would read on the net, where Munger gave a speech saying, how do you turn $2 million into a $2 trillion company? And all of you interested in investing, I would suggest you read that. Basically what you're saying, if you were stuck in Atlanta in 1884 and you had $2 million and you wanted to turn it to $2 trillion, how do you do that? And he gave the example of flavored water, or basically what became Coca-Cola. And his logic was that by 2034, there'd be 8 billion people in this world. 4 billion people would be drinking Coke with 50% market share, because everyone wants flavored water, not plain water. And if you have 4 billion people having 2 servings a day, that's 8 billion. That's about 3 trillion servings a year. If you make about 4 cents, right now Coke makes about 1.5, 2 cents a serving. Suppose you make 4 cents, you earn about $120 billion. You give it a multiple of 2, it's a $2 trillion company. Voila, you've taken $2 million and turned it into $2 trillion. Now, just the thought process, allowed us to think long-term in businesses. If Munger could think 150 years down the road, we could think 20 years down the road. So he's been invaluable in terms of our thinking.
Absolutely, and I think that's very nicely put from everyone here on the panel. Let's get into our topic, and I think what we've heard from everyone about Mr. Munger gives us a nice segue into talking about value creation, which is the first of the 3 topics that we want to talk about. Just one quick thing, we are talking about Mr. Munger's era and how he's compounded money over a period of time. First of all, is the world a very different place now? I mean, is what they have done possible in the current era? I just want to start with you. And, Mihir, Raamdeo ji, Utpal bhai, everyone please jump in if you want to come in. It'll make it more engaging, and instead of me going around the... please, Mr. Damani.
I actually differ from Munger. Munger said it gets harder to do it because there's more information, it's more competitive. But I think the opportunities are there every day in this world. I mean, okay, India is an emerging market. There is not well-researched, you got the opportunities. But in the last 20 years in America, you got companies like NVIDIA, Amazon, Google. All of them are 50 baggers, 100 baggers, MasterCard in the last 25 years or so. So opportunities are abundant. I mean, they may not come in the same, dress in the same clothes, but my feeling is the opportunities in the next 20 years in the world will probably be far sharper than they were in the last 20.
All of the panelists here have found multi-baggers. They've made a lot of money on the back of those. So I want to, Mr. Damani, start by asking you, in the value creation process, which are the common characteristics which are most enduring, which are common to all of the big sort of ideas that you've had which have allowed you to make money?
Yeah, great. Prashant, I think most people will, say, the usual stuff, great opportunity, great management, free cash flow, which are all, of course, true. I'm not disputing that. I'll just share with you a few other things that I have found that have worked, that have helped me, for example. Of course, one is management focus. You want people who are focused on doing their business. I mean, they get their hands dirty. They're not running the business from an ivory tower, but they're running it hands-on. So focus is very important. But here are a few of the things that I found that ultimately great stocks are made of. First, they don't dilute the equity. They really protect their equity. If you go back and study the 100 baggers, I think they're very, very spare of diluting the equity. So, in fact, some of the 100 baggers I've had have never diluted the equity since the inception. They use the free cash flow, regenerate the money out there. The second technical factor which I found, just for fun, I'll tell you that, is that if you buy a particular stock as it gets out from a bear market into a bull market, and the price at which you buy it never comes back. Almost always you'll buy something and the price goes down, again price goes up, again price goes down. But once in a while you'll have this rare breed of stocks where the price will never come back to the price you bought it. You're onto something special. These stocks go on to become 50 baggers, 100 baggers over a period of time. And the most important thing to enjoy, as Munger used to say, these stocks, is delayed gratification. It's a very common perception that amateurs have, that if a stock is doubled, I'll sell half of it, I become free. That's a pretty silly thing to do. You want to delay your gratification. That Infosys that you bought at 100 rupees in the IPO became 200, 400, 800, kept multiplying. If you had sold half of that, you would be half as rich as you probably were supposed to be. So these are just some of the things that I found. Of course, the other ones, the people will add on, are all very, very important.
Raamdeo ji, you want to add to that? I mean, what are the sort of common characteristics which you found in the big winners that you've had over the last 3 decades and more?
Yeah, one other thing is I mean, of the 3-4 big ones I had, one or two were truly lucky strike, in the sense that I thought something and turned out to be something else, like Aisha and all. But companies like Hero MotoCorp, Bharti Airtel, I mean, I could see it coming, in the sense that what happens is, if the ideas are new, if the company is emerging brand new, if the industry is starting, market doesn't have a track record of valuing those companies. So then markets remain, results start coming, you have understanding of the company or the industry growing exponentially, whereas market doesn't have a track record. So it tends to remain skeptic about that particular company because the past has been bad. So you get very reasonably priced. I mean, if you want to make exponential return, I think buying cheap or buying reasonable is literally non-negotiable. Now the issue is that once you buy those companies, whether the earnings explode. If earnings explode and you have bought at a reasonable price, I think that's the recipe. And one gets once in a while those kind of opportunities. And then staying through that exponentiality, like in Bharti, when I bought at 24 bucks, market cap was 5,000 crores. I could see the company is going to make 10,000 crores. Sorry, 25,000 crores in the next 5 years. You could buy it for 5,000 crores. And you could buy like 5% of the company. But there was no belief. People made me sell in next 1 or 2 months. Then I made it 10x, Then it went to 90. My analyst left me. So, you also need a lot of courage to stand in front of the profit which you are amassing. Your stock is up 10x and you are still saying that, boss, I'm not worried. Let me just carry on. So that is because compounding happens over next 4 years, 5 years. But if you get satisfied at 3, 4, 5x and then you take your profit and go away, then the compounding doesn't work. The multi-baggers don't really fructify. So like in Hero MotoCorp, you could buy it for 1,000 crores. Today it is maybe 70, 80,000 crores. And the dividends they have given is many thousand crores they have given by way of dividend. So I think when you get a great company at early, see, India is trending. India is the fastest growth country in the world. So you grow at about 6.5%, nominal GDP growth of 11, 12%. So there are a lot of companies which are going to grow at 15, 20, 25%. The issue is that can we buy those companies at not very cheap, but at reasonable price? And then rest all depends on the company, how it scales up. So this is the formula which has worked for me, whether it is Hero MotoCorp, Bharti, Infosys, then, Aisha, those, but fundamentally we bought it at very reasonable price. And then earnings exploded.
Two things. One, how much, you started to buy with luck. You said luck. You began by answering. How much is that? That is one. And second, is it a sunrise industry? I mean, a prerequisite. And the company itself being, in a way, a first mover. And that's what enables you as a investor to understand what the opportunity is before others. Because if everyone understands it, then the opportunity is gone. Yeah, so they are emerging industries because newer industries keep coming. Like wireless telecom, we talked about value migration that will come up. But, every time there is some value migration, like when in 96, 97, first time I understood what is software. Like in 95, 96, Ramesh may laugh, but I didn't know the difference between software and hardware in 95. Okay, and I read in FT the Y2K coming, and that opened my eyes. And at that point of time, your Satyam, Infosys, they were available for less than 1,000 crores, all the companies. So you could buy as much as you wanted. So, this kind of new waves come, emerging opportunities come. At that time, Indian tech industry was less than $1 billion. Total export of the industry was less than $1 billion, which is now $200 billion. So this kind of opportunity you get, and we bought Infosys at about 900, went to 11, 12,000 in next 18 months, 20 months. So you get the emerging opportunities which will keep coming in this new world from the tech side. And since India is, we have nothing, we don't have even housing. You can get Infosys kind of growth even in a housing company. So this country will throw a lot of growth opportunities and well-run companies in them. You got to be not going with the crooks. That is very important. Because they will go to hell and you will also go to the hell. So what is important is to buy clean companies and competent companies, passionate companies, growth. In India, almost every company wants to grow.
The issue is, are they going to grow it right way or wrong way? So when you buy a competent company who is trying to grow it right way, and you just plug along, I think you are going to make a lot of money.
Utpal bhai, what's been your experience? I mean, you've had Rakesh as a partner for so long. You've seen him work at close quarters. What are the common characteristics, threads that you can see, which are common throughout businesses which have done well, which have created a value?
Right. Let me start by saying that, by quoting Bill Gates, he says, we usually overestimate what may happen in 1 year and underestimate what may happen in 10 years. And I found that to be true during our investment experiences as well. I think all of us severely underestimate the terminal value of what can be possible. I'm sure, just like Raamdeo ji mentioned, when you buy those humongous multi-baggers, when you buy them, I don't think any of the investors would have ever expected that this would be a 100-bagger or this would be a 50-bagger, right? But it happens because of those characteristics.
So Raamdeo ji spoke about Bharti. I mean, why not use, say, Titan as an example? When you guys bought it, what was the framework? What was the idea at that point in time? And what allowed you to hold on to it for so long? As they say, the long term is made up of very many short terms, right? So you got to hold through all those short terms to get to the long term. What was the idea?
Okay, so, everybody knows about our experience with Titan, but let me extract a few of the intangibles which made all the difference. So I call it ABCD. A is adaptability. We find that companies which are not adaptable miss out on creating that long-term value. Okay? The second is belief in fairness. So people talk about corporate governance and all of that. You could tick every box of corporate governance and still not be fair to the minority shareholders. Okay? Because it is not tick the boxes. It is a mindset. It is a belief system of the promoter or the management team. So that is the belief in fairness. The third is what I call as culture. That culture is what the management team and the promoters create in that company. It's an intangible. You can never measure it. There is no ratio for that. But it is that culture which determines or has the greatest impact on the terminal value. This culture is reflected in everything that they do. It's reflected in their capital allocation. It is reflected in their commitment to the business. It is reflected in the consistency with which they deliver. And the last is the D. That D is essentially what the company can deliver over a period of time without compromising on anything. You talked about growth. We have good cholesterol and bad cholesterol. I believe we have good growth and bad growth. When you're delivering growth for the sake of growth, you will end up destroying value. You will end up with wrong capital allocation. When you're delivering true growth without trying to compromise on the quality of that growth, that is...
Can you give an example? And what is bad growth? What would constitute bad growth?
Okay. So if the company is delivering a 20% return on capital employed and it tries to grow at 40%, you will have a negative free cash flow. You will need external capital to sustain that growth rate, which is okay so long as the incremental growth is also delivering 20% plus return on capital employed. But if the incremental capital is delivering 10% return on capital employed, then that would be bad growth.
But I want to ask you, would you want to take any other example? You've got so many big winners there's CRISIL, there's so many others.
Sure.
Use one as an example because these are well in the past.
Sure.
I think it'll be very instructive for the people who are sitting here.
Sure.
What was the framework and the common characteristics, so as to speak?
Sure. So we invested in a company called Metro Shoes, which is now called Metro Brands, which came out with an IPO some time ago. And we invested in 2006. Incidentally, we had sold Relaxo footwear and bought Metro Shoes. The frugality that we saw in that company, the culture of precision, the culture of governance, how the company looked at risk, the prudence which was part of their culture, and the execution which was part of their culture, gave us tremendous belief in that. This is not to take away from Relaxo in any manner at all. And I'm not comparing the two. I'm just saying that we found that Metro really ticked all the boxes. The unit economics that Metro had were so good then and continue to be so good now. This was one company which was delivering 92% of their total sales at full price. We had not come across any other specialty retailer delivering that. This was one company which was delivering more than 20,000 rupees per square feet sales with more than 52% gross margin. We had not come across anybody other than Titan who could deliver similar numbers, not exactly same numbers. So therefore, looking at these micro variables and putting them together and how that creates an image of terminal value in your mind. And we call it terminal value investing, where we are not focused on the DCF number of the terminal value. There is no mathematical formula to it. This terminal value is something in the future, let's say 10 years. You have a nebulous assessment of it, and it is dynamic.
But in the ballpark, it's a number. It's a idea of a number.
The direction is important. It's like if you're standing at the base camp of Mount Everest, but you can't see Mount Everest because of the clouds. You do know that Mount Everest is there. You may not be able to see it.
Well put. Mihir, same question to you. Tell us, what are the most important characteristics you found which have helped you avoid pitfalls and kind of ride the winners?
So I think I remember one of Raamdeoji's studies, and that really, I really absorbed that in a good way. Multi-baggers are created and wealth is created when the return on capital is of course high, but the company and the size of the opportunity is so high that you're able to deploy larger and larger amounts of capital at the same rate of returns. And that's when the compounding machine really kicks in. So I just went back to 20 years ago, since when we have the Bloomberg data, and did an analysis of one of the largest banks. And our MBA genes, or MBA teachings, so to say, typically tell us that you extrapolate a high growth phase for the first few years, then a medium growth phase and terminal growth phase after 10, 15 years. And for some reason, I don't know why, but that terminal growth rate assumption always tends to be about 5% after 10 years or 15 years. So I looked at the market cap of that bank in that year, in 2005, and ran that 25% CAGR for the first few years, then 15%, and then 5% terminal growth rate. And like a good analyst, I would have gotten an upside of over 40%. So the stock would have been a buy. It's a good buy, right? 40% upside. Then I went back, because now we have the data for the last 25 years, and did the calculation based on actuals. If I knew the profits for the next 25 years for this bank, what would have been the value? What value would I have ascribed to it? And the result is 700%. So our models are so horribly wrong because we are not able to see the kind of opportunity that is out there, whether it was because of that business model or just the sheer side of the economy or the transition from PSU banks to private sector banks. So the point is that, as Utpal mentioned, we are probably always overestimating the shorter term and underestimating the longer term, especially in high growth companies or high growth countries like India. And that's where the faith and the patience to hold a concept for a long period of time really helps.
You know, when we talk about the size of the opportunity, Mihir, you were telling me some numbers. Why don't you share that with the audience in terms of, this is GDP number.
Yeah, so I mean, market cap,
market
GDP,
cap,
both ways. You know, as a fund manager, when you go out and pitch your funds or the market to anybody on the sidelines, people always come and ask, you know, what is the next multi-bagger? So, and I said, why do you want to find the next multi-bagger when the market itself has been a multi-bagger? The Indian Nifty itself has delivered the best returns in the world, equal to NASDAQ. Almost 10% CAGR for the last 25 years. In 2001, first of all, I think we should all celebrate. I don't know why you didn't mention it. CNBC typically takes out the balloons and caps when we cross a certain milestone. So we are at new high. Please clap. We are at a new high, and we are at $4 trillion. So two achievements today. Market is $4 trillion.
Caps will come out at 30,000. Go on, please.
So we are $4 trillion. Point is, in 2001 we are $0.1 trillion. We are $100 billion. It took about 6 years to reach from 0.1 trillion to 1 trillion, which was achieved in May of 2007. It took another 10 years to reach from 1 trillion to 2 trillion. So we reached 2 trillion in July of 2017. After that, the next trillion has come in 3.8 years. That is, we reached 3 trillion in May 2021. And after that, the next trillion has come in 2.5 years. So Raamdeo ji, your old study of GDP, where you use the concept of next $1 trillion, the market cap is achieving it faster than the GDP. So the pace of wealth creation in India has been so high that we've always underestimated the pace for the country as a whole. And if you drill down to stock picking and all, it's been a miracle.
You want to add to that, Raamdeo ji?
Yeah, I mean, see, we always estimated the GDP because GDP is much more kind of you can do linear progression and count that. So we call it next $1 trillion opportunity. We started counting from 2007, and we are at 3.8 or something like that. And we expect by 2031-32 will be $8 trillion. But what Mihir is doing is, I think, more brilliant, because at the end of it, what matters is how much wealth you have. As a country, we have about, say, 4 trillion plus counting, and China today is at about 9. So on that count, I mean, on GDP basis, we are 1/4 or less than 1/4, but on a market cap basis, we are almost like 50, 45, 47%. I think, I don't know, I'm not an economist, I can't figure out, but there is some merit in looking India versus China on that parameter also.
But is that good or bad for future?
Good, damn good. See, in my country, entrepreneurs, innovation, that's being rewarded, that's being capitalized. They're punishing them.
Or are we pricing future growth now?
Obviously, some
we're taking from the future.
China returns for the last 25 years as zero. Chinese stock market has given nothing for the last 20 years.
So clearly, the markets are looking well into the future. At times it is a little more into the future. But the entrepreneurship and, I mean, I was most stunned by one of the utterances of the regulator the other day when she said that the main purpose of SEBI is to help capital formation in the economy. This is a change of times. We knew regulators who were trying to develop, restrict, and bring all kinds of discipline. But today the mandate is changed. They want to do capitalization. They want to bring capital formation. And you see the pace at which the IPOs are being cleared, the way it is being listed. I think it is T+3. I don't know. I think on the same day listing also might be possible for the IPOs. So I think a lot is happening. And market is clearly giving thumbs up. I mean, you just see the biggest revolution is the Demat account opening. 100,000 per day. 100,000 per day. Almost $2.5 to $3 million. I was telling Ramesh, Saturday, Sunday included. So we are getting about 2 to 2.5 million per month. We are at 130. We are headed for 500 million. If by chance 500 million, that is 30% of the population, if we open Demat account and of that, only 40-50% remain active, you can imagine what kind of a bull run for how long we are going to have.
Absolutely. I mean, as they say,
Prashant, if I
may
add, you know, while I talked about the D for delivery, I forgot to mention one more important aspect of D, which was durability. And that durability is even more critical than everything else. I think all the great multi-baggers, I remember calling up one of the greatest investors in India, congratulating him on a great investment recently. And he said, you know, we've made very good IRR on this. I'm happy. But I'm more happy about the fact that we've made this IRR over 22 years. He says, delivering this IRR over 5 years might have been easier. But delivering it over 22 years is, so that durability is very critical.
Absolutely. Well said. So just to take off from what Raamdeo was also saying earlier, and I think Mihir also made the point very well. As they say, the first rule of fishing is to fish where the fish are, right? To go where the fish are. And I think we all agree that this is the market where there are lots of fish. We just need to find the way to fish, and that's what we're trying to do here. So let me move on to the next kind of segment here, which is value migration. Value creation, value migration. And I think all of us agree that the champion here to talk about value migration is Raamdeo. Raamdeo, so why don't you take us through where are the biggest migration opportunities you see them happening right now with the longest runway for growth?
I think the biggest migration, and I picked up the stock after reading the book, that is Infosys. If I'm not wrong, if you go to Infosys library, right in the front this book is kept. So we are biggest beneficiary of value migration from Boston to Bangalore. From, as I said, from $1 billion, we have already reached 200 billion. And yesterday only in the tech conference, they have said by 2030 it will be 350 billion. And most likely because of this and GCCs, that services exports, I mean, some of the economists are saying by 2026, we'll have trade surplus, combined export and import will be surplus, and then, you know, I mean, currency and everything will happen. So once you have this value migration happening, I think what Utpal said, when you can see this kind of trend happening, you don't know how big it will become over a period of 10, 15, 20 years. Like the new one, the latest one is fossil to non-fossil, from fossil fuel to renewables. Now, I mean, this just about started. Even the countries are not happy with that amount of work which is being done. And the challenge is so big, you can see this year Amazon is dry. There is no rains in Brazil. The whole world's biggest river is dry today. So I think there is an impact of so-called global warming, and maybe the worst is ahead. So at least the world has decided politically also to go from fossil to non-fossil, as much as they can do it in next 10, 15, 20, 30 years also. So I think it's going to be a decadal opportunity. How you play it, that's a different thing. So that's a brand new trend which I see. So there are a lot of trend, like public sector to private sector. Still we have done 40%. I mean, the market share gains, if you read today, some days back I saw in FT that in the current year, in the first half in US, 48% of all the banking profits, which is booming right now, is made by 4 banks. In US, only 4 banks have made all the 48% of the profit. And for information, they don't have 20, 30 banks. They have thousands of banks, 4,000, 5,000 banks there. 100, 200 went under in last 1 year. So despite having so many banks, there is a way this profit is being made. And in India, all these 4, 5 banks, which are large ones, they are going to mint money. Because once the scale comes, the kind of power you have in the economy, with the customer, with the corporates, I think at a scale, I mean technology, whether you are a $100 billion bank or a $1 trillion bank, technology is more or less same. So I think the PSU to private sector banking opportunity is still there, and it is going to become bigger because the industry is growing at 15%. On top of it, you have 50% more to lose or at least 1/3 more to lose to private sector. So I don't know what will be size. Right now it is 150 trillion credit market. In next 5 years, it might be a 300 trillion credit market. How many banks are there to underwrite that? You know. So that second one. Then so like that.
I'll come back to you with more examples. Mr. Damani, you're a big votary of public sector stocks, public sector banks. Do you agree with that thesis? Value migration, value will continue to migrate. I thought PSU banks are getting efficient. They're getting better.
Bob, I agree with him, value migration. My only problem is that it's always to be done at a price. Infosys is one of the great stocks for 10 years between 2001 and 2010. It didn't give any returns. Lever didn't give any returns. So you have to back up that with a price. I mean, private sector banks might be the best thing since sliced bread, but you haven't made money in 3 years in that, right? I mean, they've all been underperforming, while you made 5x, 10x your money in public sector banks. So value migration is a great theory, but it's always at a price. That's my only point.
Raamdeo, any?
Yeah, see, ultimately what does? See, they price private sector so much, and they underprice public sector so much. And so you can get at 0.2 book, 0.3 book. That's also unfair. See, what is going to happen in economy and banks is one thing, but what market does is yet another. They're exploiting inefficiency of the market. I mean, to price any public sector bank or any bank, 0.2 or 0.3 book is going to definitely create opportunity of going 5 to 10x in next 1 or 2 years. But they're not the trade to sit on. You make your 5x and run.
Okay, make your 5x and run. But and this is a longer term kind of idea. Value migration, it happens, it takes a long time. But as you said, it's a train that you can sit on comfortably without...
Yeah, so the biggest migration is happening in capital market.
Right.
From full service physical broking to digital broking. I could see Zerodha happening, but we're helpless. We're stuck with our own old system. Today we are phygital, they are digital. You see at what pace...
You have a broking business, Raamdeo.
Yeah, that's why I'm telling you from inside institutory. You know, this is absolutely happening in my house. When we started as sub-brokers in 87, there were 500 brokers. Today, none of them are there in the forefront. They're all there, but they're marginalized, completely marginalized. Who are there? The guys who came with the technology. And now, the same 4, 5, 7, we are left. Now, the completely top 6 are all digital brokers. We are not there. Motilal Oswal might be 9th or 10th in terms of market share. Profit is different issue, but so migration happens right in front of you. You know, this migration from old style broking to digital broking is happening right, and I think even 1/3 has not happened. Still,
so as an investor, if somebody took a bet that Motilal Oswal as a broker will adapt and become a new age broker, will move digital, that is the right bet to take, or that would have been the right bet to take, or the wrong bet to take? I mean, I'm just trying to understand in the context of what we're discussing. When you say value migration, you bet on the new guy who's doing things better in a different way, in a new way. But there are also existing, entrenched, well-capitalized players who can leapfrog. Right? It's not unthinkable that may not happen. We're seeing that in EV. Many believe that the best way to play electric vehicles is to buy the old IC engine players because they have the capacity to do it. So just your thoughts.
I'm chairman of the company. I need to be careful what I'm saying. But see, the point is they have business model, we have business model. Okay, our business model is phygital. Their business model is digital. But I can see the way, see this 130 million is not possible without digital infrastructure and without digital brokers. I mean, in tier 6 city, who the hell is going to go and open their forms? But today they can open in 5 minutes, and the way they can use the technology, we cannot use it. So clearly this entire thing is possible because of them. Because the complex products like all this monthly expiry, weekly expiry, daily expiry, option products and all, these are happening. So these, I mean, yesterday's volume, you know, what was the volume yesterday? Nominal value? Guess, anybody knows about it? 649 lakh crores. Yesterday's volume clearance. And no sound, it is T+1, zero defect clearance. There is no machine in the world like NSE. Believe me, 649 lakh crores. And they are capable to do 1,000 lakh crores without any problem. So what I'm saying is, this is the biggest revolution on, biggest revolution. And this has a, you see what happened to yesterday's GDP numbers. Even the RBI bank economist was 6.5. What they delivered? 7.6. And governor, just 15 days back in some forum, he said Most likely GDP numbers are higher, yet economists, they were not buzzing. And still they are saying second half will be better. Just see, they will get the shock of their life.
It'll be stronger.
It will be much stronger.
Much stronger.
And one of the contributor is the confidence of the entrepreneurs. And that confidence is coming from the capital market.
Okay.
Because they know now for sure they can get as much capital they want on their terms.
Absolutely. So you identified what the big themes: private to public to private banks. The other one was online financial services, which are moving online.
No, telecom.
Broking.
Telecom from wire to wireless, where Bharti happened.
Right.
So there are lots of these small, but these are big ones. I think the biggest of all is Bangalore. And now,
What about online ordering?
pardon?
Online ordering. I mean.
Yeah, all kinds of. Now the grocery, from physical grocery to digital grocery, where Instamart and Blinkit, Zepto, they can deliver in less than 10 minutes.
Is that the thesis behind? Is value migration the theme behind?
It is a perfect value migration.
Zomato as well. Is that the?
That's Zomato is more kind of a value creation, in the sense that you're not replacing anybody. You are just your food is being delivered from say restaurant to your place. So I would call it not so much value migration, but this grocery thing is clearly a value migration.
But there's no public way to play it. There's no listed way to.
Why Zomato itself is there?
Zomato itself. I mean, quick commerce, etc.
Quick commerce, I'm saying, and it will become very large. Because why it will become large? One, see today, organized retail itself might be 5-7% of the total retail. Of that 5%, this might be 0.5% or 0.05%. And economy is going from 4 trillion to 8 trillion and 10 trillion. So you can imagine where we are headed. I mean, they can keep growing at 50, 60, 70% for next 10, 15 years, and yet they would have not scratched the surface. It will not be even 1 or 2% of the total retail opportunity. So it's a big migration. Let's see how the industry handles.
Got it. Mr. Damani, you want to add? You didn't, get the chance to finish up. I tossed
love
it back to
hearing,
Raamdeo ji, but.
Raamdeo about I happen to be working with a retail chain. I liked his comments on digital groceries going on. It's not going to happen for a simple reason, because it's going to be an auxiliary service at best, because the package of groceries that you buy weighs about 40 kilos. How are you going to deliver that digitally at a profit? It's not possible. No one has cracked the model yet, So they'll find different models, but actually delivering it to home, I think it's a bit far-fetched. Whether it's in America or in India, it's just, labor is so costly right now. And to do that last mile delivery, it's a business, this grocery business, the best companies earn 4 or 5% margins, And you spend 5% on delivering that grocery. So it's not going to happen quickly. In terms of value migration, I think one thing that I keep thinking about is when I grew up in the 60s in India, there's only one entertainment in India. You go to the movies. Bollywood was the only entertainment. But increasingly, we have a smorgasbord available of choices, It could be professional sports. It could be wedding celebration. It could be a 50th birthday celebration. There's so many streaming services available. So the entertainment will be very big. And I think how you play it, you kind of figure it out. Whether you buy a professional sports team, or whether you play a wedding planner, or whether you play a fashion designer for weddings, or whether you play Bhabhi's favorite stock, I'm sure, Titan. So there are various ways you can skin that cat. But I think entertainment will probably be big in terms of value migration. Warren Buffett or Charlie Munger, one of them asked this famous question, why did the why did the railroads go out of business? Because they thought themselves to be in the railroad business, not in the transportation business. I think you need to think of yourself in the entertainment business, not in the movie business, and you'll do just fine.
Mihir, you want to jump in with this migration? Where do you think maximum value is migrating to? Which areas? I mean, if you can identify one or two.
So one is all technology-led. I think we discussed a lot about consumer-enabled technology enabling consumer consumption, etc. Second, of course, is the transfer from ICE engines to EV. That I think again is a big irreversible. Then we can talk about asset-light models. Again, in the fintech space, I think there's a lot of disruption. So I think tech-enabled consumption, tech-enabled finance is one broad theme we can talk about. EV, renewables, that's another theme. As per Bernstein, I think there was one study done. By 2030, in the top 500 companies in India, about 20% of the market cap will come from companies which are not existing or listed today. So that's the kind of value migration or value creation happening in the new tech space. And if I were just to, because I like numbers, if I were just to kind of summarize, this process of creation and destruction is going to continue to aid value migration. This 20% market cap that I said, which does not exist today, will happen by 2030 is creation. But if you look at the destruction, in 1995, there were about, today for example, there are about, in the Nifty 50, about 12 sectors or subsectors you can say. Out of this 12, 3 did not exist in the Nifty in 1995. And that's about 30% of the Nifty did not exist in the Nifty as a sector because they were either non-existent or were too small to be in the Nifty. So that's 30% of the Nifty which has been created in the last 25, 30 years, fresh, so to say. The Nifty composition in 1995 had 9 sectors. Now we have 12 because of 3 new sectors, which is IT, consumption, and one more. In 1995, if you were to look at those 9 sectors, only 2 sectors have increased their weightage in the Nifty, which is financials and pharma. All the other sectors which are present in the Nifty have seen their weights getting reduced. So that's another way of looking at value migration. So while the pie has grown, the relative importance and strength of sectors keep on changing. That's what I think we need to kind of keep a watch on and try to be on top of stuff.
Just to add to that point, everyone thought that the fossil fuel business would go out, and they'd beaten it down so much that the best performing stocks of the last 3 years probably been Exxon, Chevron, which are the old fossil fuel players. So value migration is great, but it always comes at a price.
One more point I would like to add is that if I were to look at value migration, we've seen a lot of value migration in asset-light industries in the last 10, 15 years, mostly consumption, IT, those kind of sectors, pharma, etc. But I think India is horribly under-invested in physical. So whether it's power, whether it's real estate, whether it's infra, I think we are horribly under-invested. And manufacturing, again, we are horribly under-invested. And if we have to grow at anything more than 5.5%, 6%, we cannot do it without physical infrastructure and capacity creation. And that, in the next 5 to 10 years, is another mega trend I think we should see value migration towards.
Just one question, Utpalji. Is there a, I'll take the example of COVID, right? Everyone thought education, for example, is going to be done online because that's how it happened for 2 years. And companies got valued at, the biggest sort of edtech company got valued at billions and billions of dollars. Forget about the fact that how it was run, but it was not real. People still want to go to classes, physical classes to learn. It's not all moving online. Is it, when we talk about migration, are there pitfalls to avoid as well? I mean, the one example, it just came to my mind straight off the bat, but one has to be careful as well. The migration is actually happening. I mean, you got to see it, you got to maybe buy it once it starts and not kind of bet on it that this is the future. It may not be. Lots of questions, for example, Mihir spoke about EVs. I just read an article which kind of said, an early proponent of, I don't remember the name now, said the energy which is required to produce an electric vehicle, actually, it's too much. So he's now saying that, well, actually, stick to your petrol cars, stick to your diesel cars for now. Your thoughts on this, value migration and as you see it and the pitfalls to avoid there.
So I'll start with another quote here that Eric Smith of Google uses. He says, change happens slowly and then suddenly. So there is an S-curve of adoption that takes place across every industry during the life cycle of that industry. Okay? There will be people who will doubt that industry. There's this famous photograph of 1905 of New York, Fifth Avenue, where there are so many horse carriages and one car. And there is the same photograph of Fifth Avenue in New York in 1912, where the street is filled with cars and one horse carriage. So in 7 years, you have that kind of migration. So I don't want to debate on the merits and demerits of any one specific migration example that we are talking about. But yes, there are a few false dawns that do take place. And it is part of the cycle of evolution. What helps the investor differentiate between those two is the unit economics of that thing. Like earlier in the day, we had Mr. Robbie Singh of Adani talking about infrastructure, saying how they rely not on the contract, but on the compelling economics for the end user. So long as that you are able to get that compelling economics for the end user, the adoption has to happen. It is inevitable.
I mean, the unit economics will push the industry towards that thing, whatever that thing is, basically, right?
Yes.
That's the way to identify it. Raamdeo, you want to say something?
Yeah, value migration happens only if the customers get a better deal. Otherwise, it's not a theory. The theory is that, like in even this, your grocery, it might be the private equity guy who might be paying for the delivery charges. India is the most competitive place to deliver anything from anywhere. $0.50 you deliver, commercially viable. I don't think in America you can do it for even $10. So this is a place where you can deliver, but still at 4% profit, can you really run a efficient grocery thing? But today, the way consumers are getting, they are getting at same MRP or whatever, without much of change. But the convenience they are getting, so they are willing to pay a little bit for that. But if there is no better deal in the mind of the consumer, I think no migration takes place. Like from wired to wireless, it was so much easier. We have 50 million telephones in 2002, MTNL, BSNL. And we got 1 billion in next 4 years. Fastest adoption. You look at ChatGPT. I think it has done some crazy numbers in just 1 week. So these are the migrations or creation, whatever you might call. But this is a digital era. You're going to see anything moves from physical to digital. God knows where the volumes will go.
Got that. Which gets us to the last topic, which is protecting value. I just want to start by asking you, what does that mean to each of you? Is it as simple as knowing when to sell, to capturing the value? Or is it, what does it mean, Utpal? How would you frame that?
You know, to me, value preservation in the way that most investors think about it is in the form of diversification across asset classes. Within the same asset class, people think of value preservation in the way that you can sell in time and so on. But I think we are all humans, and selling in time is not necessarily a skill set that most of us have. To me, value preservation is actually derived from the way I construct the portfolio. Okay? And I think portfolio construction is an underappreciated art and science. People always focus on stock picking, but not as much on portfolio construction. If your portfolio construction is robust enough, disciplined enough, focused enough, if it is a probabilistic portfolio management which reflects your conviction, then to my mind, you are in effect doing value preservation through the science of diversification, through the science of weights. Value preservation is not the ability to buy at the bottom and sell at the top. It is the ability whereby your portfolio delivers the best possible risk-adjusted returns in sync with your capability.
Got it. So diversification, well-constructed portfolio, risk-adjusted returns. Raamdeo ji, what does that mean for you?
For me, one is that I own only one asset class, that is equity. So I am fully invested all the time for last 40 years in Indian equities, only Indian equities. So for me, risk management is about not borrowing. I am never levered. I never bought more than a rupee more than what my net worth is. In fact, I would say 99.9. You know, so that kind of, yes, it gives me shocks in terms of, I have seen 3 or 4 times when portfolio went down by 50, 60%. In 2000, in 92 first, then 2000, in 2007. All the 3 times, it went down by 50 to 60%. But I was never leveraged. So that allowed me to remain fully invested, even at the bottom, which is extremely important. When the markets come back, you got to be fully invested. And that you cannot time. So I think Maybe at times in the bottom of the market, I always hate myself. I don't have money. And by principle, I don't borrow. At the bottom, I should borrow and, buy some. I never do that. So that has kept, that has kept me in good shape. And I think that's my, risk management process.
No leverage. Mr. Damani.
I think what Raamdeo is saying also is the difference between risk and volatility. Risk is the chance of permanent loss of capital. A lot of action right now happens in the futures and options market where you can permanently lose your capital because that's a zero-sum game and it's risky to do that. Volatility is what happens, is the beast of the stock market. Typically, as Raamdeo said, stocks will fall 50% from the peak in the course of its great journey. And if you can't handle that, maybe you shouldn't be in equity. So volatility, use it as a friend. When it goes down, don't be levered, step up to the plate and buy it. Risk, where you can permanently lose your capital, avoid it by all means.
Any other sort of facets to this protecting value, either while going in, when you first go in, maybe some margin of safety, buy it at a price where you're anticipating some downside, which perhaps at some points and times is inevitable.
As many maa bolte thi, rupee ki cheez 8 mein kharido bacha. So buy with a margin of safety, buy things that are cheap. I think the thread running through this discussion today is my focus on price. It's so important to get it at the right price because that gives you that margin of safety, gives you that compounding and creates the long-term wealth you need. So I think the most important thing is, as you move out from a bearish market or bull market, there are great bargains available. You should be looking very, very attractively and anxiously at the market rather than ignoring the market at that stage because that's where money is made. The next bull market will multiply your money. You'll be shocked how much it will be multiplying. But the seeds are sown in the bottom of a bear market in despair. Just like when there's winter, that spring is around the corner. In the stock market, at the worst of bear market, the cycle will change. There was an interesting example. In 1979, the US went through a horrible bear market. The Dow hadn't moved for 1,000 years. In fact, it was so bad that the price of running a New York cab, a medallion in the New York taxi cab business, was worth more than a seat on the New York Stock Exchange. It was about $25,000 for the medallion and probably cheaper for the New York Stock Exchange. You know what happened in the next 30 years or 50 years or so. So, bear markets are a very punishing time. It's not easy, but you have to be courageous at that time.
And in a way, the vice versa as well, right? The opposite also holds true.
Yes.
Bull markets also...
There's no such thing, Prashant always says, a permanent bull market, that prices keep going to the sky. It's the nature of the market to correct. And great businesses can find a way out of that also. But typically in a bear market correction, your best stocks will be down 30%, 50%. The worst stocks will be down 90%. That's typically what happens.
Mihir, again, lean on your institutional sort of money management background to run us through what are the most important things that you see attribute to this entire value protection business.
Absolutely. So I think what the gentleman described was preserving value at your level, the portfolio level, right? I'll talk about what I look for when I'm investing in a company. So the value protection at the investment level. Leverage is one thing that I would be very wary of. The classic example over the last 10 years has been, I'm an engineer and most of the construction companies that were there in the 80s and 90s, were dream jobs for us. And as we saw in the cycle of 2008 to 2014, none of those companies exist. So the dream jobs of an engineering campus in the 90s, all those companies no longer exist or are more or less defunct. So, and they all got killed because of leverage. So leverage at the company level is something that I would be very wary of. That's one. And even before that, the promoters' intentions, the governance, the management intentions, promoter intentions. However good the industry might be, however good the company might be, if the intentions are not right, if the treatment of minority shareholders is not fair, nothing works. So it may be the best company in terms of financials or business model, but if the intentions are not right, it's worth nothing.
I think that's fairly well rounded up across the panelists. And maybe I think we're kind of hitting the time limit as well, Utpalji. Since we have all of you on the dais, and I think the audience would also like to understand where we are in the markets right now. If you can use maybe 10 minutes to talk about that.
Sure. But Prashant, if we can give a disclaimer on all the discussions, the SEBI disclaimer.
No, as Utpal says, everything which has been discussed here in terms of stocks, sectors, etc., it's all for educational purposes. I think that's been very clear. None of it is recommendation or asking anyone to buy it. So that's the standard disclaimer. But let's just talk about the market itself. Raamdeo ji, kya lagta hai?
I think this reminds me of 1992. I think greatest bull market was in 92. We were just about, we had become member of Bombay Stock Exchange. We were very young and we knew very little. I mean, except for PE and EPS, I think we didn't know any other ratios. And market was about 600-700. And we were going in one of the marriages of our friend. And everybody was shorting the market in the curb deals from the airport also. Little they knew, in next 20 months, market is going to go 7x. From 600 to 4,200. I don't think
1992.
1990 to 1992.
Okay.
So I don't think there would be any market in a space of 2 years, it would have gone up by 7x at index level. And those who have lived that, I used to take order and Motilal used to execute and all. So I have seen it absolutely first hand. So it was a crazy time. My sense is the bull run today is of that order. But thanks to SEBI, thanks to all the discipline, DMAT, T+1 settlement, all kinds of control we have on everything. How long?
So 7x will take how long?
That I don't know. But what I'm saying is that, I think picture is much better. At that point of time, economy was broken. It was just on the eve of that bankruptcy thing we did. So I feel very bullish. I don't know about the numbers. Maybe chartists can give you, but I never felt like this in many years. I can tell you this.
Okay, that is that is a very bullish sort of comment, and I think, Mr. Damani, would you echo that?
I would just say this, I'm not an astrologer. No one knows where the next 2,000 points are on the Nifty. Is it down or up? It could be either way perhaps. But I'm pretty sure the next 20,000 points are up on the Nifty.
The next 20,000 points?
I'm not saying it's happening in 3 years. I'm saying in my lifetime, if the others is 40,000, then, go down. It's just onward and upward. We remain bullish. And last 30 years, what has it taught us? Remain invested in Indian equities, because that's what will, earn you a superior rate of return. So I don't mean that facetiously. I'm saying the next leg is higher for people. So by the time a next generation comes on this platform, the index will seem even higher. Next 2,000 points can happen anyway. That's what I call volatility in the market.
Maybe the short term is completely unknowable, but the point is, do you feel comfortable with valuations, etc.? One thing which constantly now, many on the institutional side have also started pointing out that mid caps and small caps perhaps are, it's almost become consensus.
It's a left out feeling, They haven't invested, left out. They haven't got the public sector, oh, these are a bubble, oh, this is a bubble. I think I've heard that for too long for me to believe it. I think remain invested in good quality businesses, don't get levered and, just enjoy the ride. It's amazing.
Mihir, any thoughts? And start with mid and small caps, because I only half jokingly say that the Indian small cap index is the strongest index in the world. And actually it is true.
But it's factually true, I think. So the point is that, just talking about small and mid caps, if you want to participate in the highest growth segments or sub-segments in the market, there is no choice in the large caps, right? You're not going to find a, railway stock or a defense stock in the Nifty 50. So you'll have to go down and search for those kind of themes and trends in the mid and small cap space. So I don't think we have a choice there. That's the way it is. And they are, as we discussed, there is a tendency for us to probably underestimate the longer term implications of what's happening in some of the sub-segments. So that's something that, one needs to keep in mind. And the other thing, broad comment of the market is that I've never seen the case for India versus the rest of the world being stronger. It's never ever been India related to the rest of the world. It's never ever been stronger. So I think As long as we don't really, do something dramatically wrong ourselves, it's our time.
No, absolutely. Mr. Damani, you invested in, I remember you came on CNBC, you spoke about railway stocks, you spoke about defense stocks at a time when, the rally had not started. No one wanted to buy those stocks. And they've done tremendously well. I spoke with you on, I think, the day of Diwali. And I remember you saying that maybe first, they may sort of consolidate for a while, maybe, take a breather, but the long term is still good. You still echo that view just to kind of explain that point?
Yeah, Prashant, I always believe that every bull market has leadership. So in 92, it was the cement stocks, 2000 was the technology stocks. I personally started to believe that the leader in this bull market is the public sector stocks because they were so cheap and so unloved, and they're getting better corporate governance. I think one thing the center has done is get better corporate governance out there. A lot of the telephone banking is over. A lot of the corruption seems to have, diminished quite considerably. So if there's leadership, you can see the leadership stocks in technology or in software or in cement. The stocks go up 20, 50x sometimes from the peak. ACC went from 100 to 10,000 rupees. Okay, so I think the leadership is there. So I think you may not want to buy a particular defense stock now because it's gone up so much. But the gas, housing, there are lots of opportunities available. So I think I would allocate part of the money to the public sector stocks because I think they're the leadership. And if you miss them, I think you're going to feel the pain somewhat in returns.
But railway, defense, any other area, banks, of course, in public sector? Anything?
You have choices in, finance companies, you have choices in, gas companies, engineering companies, consulting companies. I'm not recommending anything. I'm just saying that there are plenty of choices where they're still cheap and you can still get great bargains. I think the market's wising up to it. IRDA, which recently listed a few days back, doubled in valuation in 3 days. So market is getting wise up to it. But you look at the broader canvas of public sector stocks, if you believe that this is the leadership, and so they will lead this bull market higher, then you want to find stocks that, will probably benefit from that. So they will require a P re-rating from 5, 7, 8 to maybe 15, 17. So that gives you a lot of returns and opportunities.
Raamdeo, any sectors which, financials is of course your top idea, top bet, it has been for a long time. Anything else from here? You're extremely bullish. What's the best way to play it, briefly?
No, first, I would say that remain as much allocated in your portfolio about equities. That's the main thing because we focus too much on identifying a stock. That is not important because everybody focuses on what multi-bagger I have got in my portfolio. But actually, the guys who have got multi-baggers, when they look at their 10-year statement, they realize that total portfolio return is not more than 14-15%. So I think what is most important is to remain allocated in this great time. And whether it gives 14%, 15%, so that's first thing. Remain allocated as much as possible. But rest all now stock, financial, why I say about financial services or even the capital market services, I would say, where we are very closely associated. Because in last 25 years, total savings of the economy was $10 to $12 trillion. If you add up everything, household, government, and corporates, in next 25 years, it is going to be $100 to $150 trillion. And I could be wrong by 5 here and there, but 100 is not negotiable. So in that tsunami of savings, all the institutions which are, whether it is a bank, whether it is a mutual fund, whether it is a brokerage, clearing house, exchanges, at different scale, they are going to have disproportionate opportunity coming to them. So and some of the businesses are asset light also. When you have growth as well as asset lightedness, then you have a terrific combination of value creation. So that's why, I'm close to that sector also. Even insurance, health insurance. So these things are definitely very large, value creating as well as value migrating, both combination and asset light. All three coming together in next 10, 15, 20 years. So those are the places where your allocation should be good.
Utpal, last word to you. If Rakeshji was with us, we all know what his answer to this question would have been. He would have thumped the table and said that the story, abhi to story chalu hui hai. Your thoughts.
Yeah. I think Rakeshji used to always tell us that the mother of all bull markets is not behind us, it's ahead of us. The best is yet to come. I think all that he envisaged is actually playing out beautifully. And it reminds me of an article which we wrote together in 2002 in Economic Times. And 21 years later, I can see all that he had envisaged having played out brilliantly. I still feel that in today's markets, one may have some discomfort about certain aspects of valuation. But let us step back a little and see that the structural volatility in exchange rates, in interest rates, in growth rates, and in inflation have come down. The natural corollary of that is that the volatility in the stock market has also come down. This reduction of volatility in stock markets has to lead to an increase in multiples, which is happening, which has happened. And a large part of this increase in multiples actually is in the small and mid-cap companies. I think the reduction in tax rate in September 2019 was a big catalyst for this change to happen. Because there was already decent governance in the large cap. The incentive for poor governance in the small and mid-cap space went down. So I think we are seeing that combined with the shift from unorganized to organized, where the displacement is taking place, which has increased the structural pricing power, and with greater degree of protectionism, vigilant protectionism in the country, I feel that the pricing power of the domestic players and domestic industries have gone up much more than otherwise, which is why if you see the first 1500 company results, top line growth is 4%, bottom line growth is 40%. And when that kind of earnings growth is happening, your PE multiples go out of the window. We saw what happened to NVIDIA in the US, right? The stock just ran up dramatically and the earnings are now catching up. So markets are always ahead in multiple ways. And it is not my case to say that the market is cheap or not, but I can only say that I still see opportunities around me. It may not be opportunities all across, but as Rakesh used to say, there is a buffet there. You need not eat everything. You just eat what you like.
I think that that's beautifully put, and to use Rakeshji's example as well. I think that brings us to an end to this discussion as well. Utpal ji, Raamdeo ji, Ramesh ji, Mihir, thank you very much, all of you, for joining us here. I don't know if I can ask the MC, if we have 5 minutes, if we can open the floor for 2 or 3 questions, if it's possible.
Well, that isn't my call to take, but Nipa, what do you say? Let's have the questions. Prashant, carry on.
I think we have hands up already, but we'll need a mic to be, yeah, I think the mic is coming to you. If you can introduce yourself, just your name and sort of ask the question, please.
Hello everyone, I'm Urvi Dharamshi. I work with Avada Energy. So my question primarily was that how should a mid-sized company time its IPO? What is the right time to open yourself up to the public markets? And, to subject yourself to quarterly evaluation? Is it, if you are not going to be able to pay out dividends for the first 5 years, how do you make your equity story?
What's the right time for a mid-sized company to do an IPO? And would you like anyone in particular to answer that question?
No, I think it's open to the entire esteemed panel.
Today. I mean, look at how the IPOs have been received. I mean, you want your stock to double on listing, so today is the right day to do it.
Well, that's one way to go. But
wait, Monday file for an IPO.
No, actually, this ring of truth to it with the market being so buoyant. Absolutely.
So, but if you have a lot of capital investments lined up and, the cash flows are not starting for 4 or 5 years out in the future, how do you, do this equity story in the market today?
Prestigious, you get a higher multiple, The more prolonged and the more dreams I can give you, the higher the price and market cap. So, I mean, markets and, in a phase where, I own the stock called Alexi, which, has compounded for me over 25 years or something. Tata Technology got listed in the first day, market cap crossed Alexi. So market is in that kind of mood right now. It just seems to be, valuing everything, looking ahead, no problem, full speed ahead. So if you ask me, this is a great time to file for an IPO. I'm being facetious. I know you can't do it today, but I'm just saying that, when liquidity is good, conditions are good, people are bullish, that's the time you want to hit the market.
I have a question.
Please.
Yeah. My name is Vishal Mirchandani. I've been a professional for 34 years and now an entrepreneur since 34 days. My question is, we understand that market capitalization creates capital formation, job creation, etc. But what is the correlating data of its impact on GDP? And the second part of this question...
sorry, could you... I couldn't quite get it. I'm not sure.
What is the data supporting its contribution to growth in GDP? Market capitalization growth contributing to the growth in GDP. One. And the second thing is, if you're saying that market cap is going to go from $4 trillion to $8 trillion in 7-8 years' time, it is actually giving the same correlated effect on GDP, which is projected to be 10 trillion at that point of time. So how are we going to improve efficiency of market cap to generating better growth of the country's GDP? So that both of them are quite related questions.
Raamdeo? Or...
Yeah, so I think you're asking about the correlation between the GDP growth rate and corporate earnings. Am I correct?
Yes.
Yeah, market cap.
And the stock market capitalization.
Yeah. So the way it is connected is that typically in an economy, there is always fight between labor and capital. So capital gets about anywhere between 3 to 7%, at least in Indian history, of the GDP. So if GDP is, so in 2003, it was about 2%. In 2007, it went to as high as 7% of the GDP, then GDP. Right now, we're at about 5% of GDP. So generally, it is believed in an improving segment that if your nominal GDP is growing at about 12%, my corporate profit should grow about 15-16% in a good situation. So when we double from 4 to 8 trillion and my corporate profit to GDP still remains at 5%. I'm just saying that let's keep it 5 only. So my corporate profit at that point of time, of the 10 trillion, 5% will be $500 billion. So it will be more like $500 billion in today's exchange rate. It will be more like 41 lakh crores whenever it happens. Right now, this number is about 12 to 13 lakh crores. And the multiple, say today it is 22 times of the trailing 12 months P multiple. So if you give the same multiple at that point of time of that profit, then you will connect the market cap to GDP, which will be about 1 time or 1.2 times, 1.3 times, depending on the nominal GDP. So that's how GDP, corporate profit, and market cap connects each other.
Okay, I think last question, please, quickly.
Thank you, sir, for giving this honor. I'm Saharsh Jain. My question is, to a common people, there's always a debate about debt or equity. As India is rising and we are having new type of debts structures coming up all the time, which they are giving an IRR of 16-17%, even more. And as Sir Raamdeo Agarwal has said that he's totally into equity, 100%. Now, my question is, after invested for so many years, how do you feel like if you want to go and switch to debt market after looking at the age or the risk appetite, or maybe what do you suggest?
That's a question on asset allocation. Utpal, you want to take it?
They say in one of the Hollywood movies that gentlemen prefer bonds. Right now, nobody seems to be a gentleman here. Everybody is preferring equity. But in the long run, especially for institutional investors and those investors who have a charter, investor charter to adhere to, they will do whatever is necessary to fulfill that charter. So for example, an insurance company cannot put all its money into equities and so on, right? Or the pension fund cannot put all its money into equities. So I think there is a space for both equities and real estate and commodities and equities in different people's portfolio depending on their risk appetite and their priorities. However, in the last 15-20 years, what we have seen is that equities as an asset class has outperformed significantly when you include all the companies, okay? If you include only the indices, then the outperformance is still there, but on a risk-adjusted basis, the outperformance is much smaller. What is the best thing is that in a negative real interest rate scenario, which has prevailed for a long period of time, no longer, but earlier it was prevailing. During that time, obviously equities would be fantastic. Now that we don't have a negative real interest rate scenario, I think there is a case for some balance of fixed income. But you must realize that optionality is very important in a portfolio. A 100% equity portfolio does not give you optionality. If you're holding some cash, it gives you some optionality. So it is up to the risk appetite of each investor of how you allocate assets.
Thank you, sir. Thank you.
Thank you, Prashant. Thank you for moderating this last session so ably. May I please request Mrs. Nipa Sheth to join us on the dais to present mementos to all of our panelists. Pranav Inamdar was anyway going to join us to render the vote of thanks and summarize the day he's here with Nipa to present mementos to the Honorable Moderator and the panelists of this session. Ladies and gentlemen. We'd like to thank Prashant Nair, Mr. Ramesh Damani, Mr. Utpal Sheth, who's one of us, but thank you for participating in this panel. Mr. Raamdeo Agarwal, thank you very much to you too, sir. I request you all to come together for a group photograph, please. And with that, ladies and gentlemen, I hand this over to Mr. Pranav Inamdar for summarizing the day and rendering the vote of thanks, please.
Good evening. I won't make it long. Let me start my closing session with a sincere thanks to Honorable Minister Shri Piyush Goyal for blessing this event. We thank all the panelists, all the issuers, investors, eminent dignitaries, and each one of you for joining us for the third edition of India Debt Capital Market Summit, Onward and Upward. With this, we come to the end of the summit, which is the panel session. However, we look forward to having an interesting networking session over cocktails and dinners and evening entertainment. So thank you once again. Thank you.
Very quickly, ladies and gentlemen, I'm going to invite on stage our business heads, the entire team here at the Trust Group for a group photograph on stage. Pranav Inamdar is here with me on stage. Abhishek Kedia, On India Sen, Hani Jalan, Parag Kothari, Anant Jame, Baladharan, Anil Ranka, Homi Tarapur, Sandeep Bagla, Mihir Vohra, Samir Kaul, Upendra Jaiswal, Nirita Bose, Ashish Srivastava, Hiren Mehta, Darshan Ringshia, Ajay Kumar Gupta, Anand Nivitia, Satvik Tandon, Vishesh Dalal, Harshvardhan, Sujal Desai. Could you all please join me on stage for the group photograph? And while they're all stepping up,